Investment real estate is much different than selling owner-occupied homes. If any property receives income for a period of time, it is considered an investment and subject to investment rules. Now, if you do not live in the house for a period of time and you rent it out, then it's not your personal residence. Pretty simple. It is a rental. Houses that are rented out for whatever reason are considered rental income investments and are subject to IRS guidelines. Just to show the impact of a property held for investment versus an owner-occupied home, I thought I would use two identical houses, the same price, the same long-term hold, and see how the differences play out tax-wise. Now, both houses are valued at $300,000 and been held for 10 years, and both have a basis of $200,000. That's the beginning purchase price. We could add debt, but we won't at this time. Now, the IRS guidelines say to get a total 1031 tax-deferred exchange, you must go equal to or up in debt and price, plus you must invest all the sale proceeds. On an owner-occupied house, there are no such requirements in this price range. You're allowed to sell the house, take the money, and invest it in any way you like, or not invest it at all. Now, as an owner-occupied owner, you also get mortgage interest deduction every year, which is like cash in your pocket. I think everyone likes mortgage interest deduction, and we hope it does not go away. However, investment real estate is allowed to deduct even more. In addition to deducting mortgage interest paid, you deduct all expenses of operation, all maintenance, repairs, and depreciation. And another big benefit is any capital improvement you make will add to your basis and will reduce your future tax bill. Now, another really good thing is the investment generates monthly income each and every month. Now, how nice is that? We all want that passive income. The kicker is, when you sell, you have to recapture depreciation at 25% and pay capital gain at 15 or 20% depending on your tax bracket. Now, to avoid that tax bill, you need to reinvest in an equal or larger like-kind investment with equal or higher debt. Not that hard. Now, in this example, the owner must reinvest all the proceeds or pay about $33,600 in tax. And the reason I know this is I've already done a tax basis analysis. So that might sound bad, but really it's not so bad. It's always bad to have to pay the tax, but you don't have to. Now, remember, the tenant is paying for the house and giving you cash flow and a long-term profit through appreciation and depreciation. And often the rate of return on rentals can be in the double digits if the investment is a quality investment. But you have another option. You can just put your funds in the low-risk bank and receive low returns. And that's called safety in investment, and that's all right. To sum it up, there are many options to an investment exit plan when you're tired of investing, and that time will come. A 1031 tax advisor can guide you to the simplest exit plan, and that won't cost you an arm and a leg. So, to all agents and clients, there is a big difference, and the difference starts at the listing contract and the intent of the owner. Now, the IRS has disallowed some 1031 exchanges because of lack of investment intent. And that could be as simple as putting it on the MLS and saying the client may seek a 1031 tax-deferred exchange. That's not intent. Now, the differences in the two house listings continue right through the closing of the deal, even though the houses are identical. Now, 1031 timelines are strict, and the use of a qualified intermediary is required, and following the rules are very strict or the exchange will be disallowed. Now, one very important consideration, you cannot have access to the funds until the exchange closes or 180 days are over, or you will possibly pay the tax. Now, the IRS is kind of touchy on this, and no, your title company cannot just hold the funds because you still have access to those funds. Now, as a broker, if you have not figured out the differences when listing and selling these two identical properties, then you are way outside your area of expertise and you can easily harm the client. You should know how to do a preliminary basis calculation, and you should know the basic requirements of a tax-deferred exchange. Now I'll give you an example. Now here's a call you do not want to get, and this is very scary. Imagine after closing the deal sometime later, a client calls up and says, "Hey, I had to pay $33,000 to the IRS because my house was a rental for 10 years. I didn't know that, and you did not tell me this when I listed the house with you. What can you do about it?" Now, do you think that indirectly this client wants that agent to pay? I would think so. Sure, the contract says the client should seek the advice of a CPA or tax attorney, but you as an agent should have known the drill at the time of the listing and should have been able to guide or even push the client to the experts. Now this looks like a bad hair day to me, and we all don't like that. Thanks for watching. This is Chuck Trice with Investment Tuesday.